Hey everyone, this is Kirk here again at optionalpha.com and doing a quick video update here after the market close on Tuesday. So today was a little bit interesting as far as the bond market is concerned. So that's what I wanted to focus on tonight in this video, and here's why it's important. So we had the Fed comments come out from their latest meeting, and everyone obviously reads through the Fed comments and what Ben and all the other Fed chairmen say about or Fed governors say about monetary policy and whether they're going to induce stimulus or what they're going to do to prop up the economy. And it was pretty clear in what they had said that they're not looking for any type of further economic easing or financial easing or QE3, as everyone else is calling it. So naturally, the markets are taking a backseat to this, right? So stocks are going to not be as vibrant as they have been in the past. They're going to start to see this as, we need to stand on our own 2 feet, I guess. And I think the market should have done that from the beginning. But stocks need to stand on their own 2 feet. They can't let the government and the Fed prop up security prices. And more importantly, what we saw today is we actually saw bond prices take a very big hit. And what I wanted to go over tonight, in addition to the bond charts, obviously, is taking a look at the intraday activity of some of the major bond ETFs and what happened with them over the last couple of days. I think some of the patterns that have evolved are almost textbook breakout and retracement patterns that we've seen on some of these charts. And so now we're starting the next or third phase of these, which is going to be a continued decline in bond prices. So with the Fed comments today, that was clearly the straw that broke the camel's back. And so I think that what we're going to see is actually lower bond prices, which in turn could mean actually higher equity prices. If bond investors move their money out of bonds, they've got to move it into either A, cash, or B, stocks typically. So let's get right to the chart here, and we'll leave Ben to the background. So this is actually a chart of the Barclays TLT, which is the 20-year Treasury bond fund, but it's really a good proxy for the whole bond fund in general. And this is actually the last 30 days intraday chart, 60-minute. What we actually saw from this chart, I'm going to use my awesome highlighter tool, is we actually saw resistance levels starting to form right here around 115. Now, please do not grade me on how straight this line is. This is freehand here. So about 114.50. And that level formed back in January. Now, we've had multiple opportunities to come down and touch that level. What I'd like to point out about how we could have seen this coming earlier, this break below this level, is that we had lower and lower highs each and every time the market tried to rally. So as it came down and hit this level and rallied, it failed at lower and lower points along the way until eventually it did break. And once it broke, it ran away hard, right? Which is, again, textbook type of a breakout, right? It hits this support level. Once it breaks fast and it runs hard to the next support level. So clearly the next support level is somewhere around 109.50, 110. Now, what's really interesting about this is that it actually came back up earlier this week. This is even before all this Fed comment news and everything, and made a successful retracement of the breakout, which again, a textbook move that it retraced this line or retested that area of resistance or of support that's going to now act as resistance. Again, this happened earlier in the week. This happened in the beginning of the month or kind of the end of March. So this was even before all this news. So clearly bond investors were starting to get out of the market. So I'll even zoom in here just a little bit further so you guys can see this, right? It retraced this move back here the last couple days of March and really fell away from that point early. So that was really our warning signal, right? The shot across the bow. And this is something that I'd gone over when we did a kind of a group webinar with some of the coaching or some of the members just the other day, is that as the market started to fall here real quick, this is kind of the warning signal that something may be coming. Now, of course, the other day, the market kind of recovered a little bit, which is pretty natural for the market to do after this kind of dead cat bounce, right? So today, though, after the Fed comments came out, look how drastically the market continued to sell off, right? I mean, it was almost instantaneously as soon as the Fed comments came out, and look at the volume, how much the volume spiked. Now, this is even on an intraday chart, and you can clearly see that this is much higher than anything else we've seen in the last month as far as volume. So the volume spike definitely shows that there's a lot of aggressive selling going on and that it was pretty hard, meaning that people were getting out at any price that they could, because they would rather get out here and take a 25 cent, 50 cent loss than to be in this thing for long term. So that is what was really key with the bond market today. If we go to the actual daily chart of the bond market, I'll go to the chart of the TLT right here. You can see that we do have some strong support, like I was talking about, right about this level, right about what is that, about 109 or so. Yeah, 108.85, 109. So really we want to see the bond market break this level strong before we can really say that we're definitely going to start a new downtrend, right? That's what we really want to see. It can definitely bounce off of here, but I think that more than likely what we're going to see is the bond market again break below this level and then wait for a comeback, and it's going to retest this level as new resistance. Okay, so that is going to be the likely move. Again, the move that it made just this month with retesting this previous area of support is textbook. Again, it's just very textbook move and really kind of foreshadowed what was actually going to happen today, right? The move actually really happened 2 days ago. And today's move is just really a confirmation of that. So I think that was the real key to take away from today's market. Obviously, you look at things like the S&P that's starting to really stall. We're not having these consistent moves higher. It's starting to really struggle to get higher. The Russell has pretty much all but stalled as well, right? It's moved off of the March lows, but not in any meaningful way. And it's really struggling to break out of this 850 level, which is where it has been before in the past. It's been the highs that it's reached before in the past. So there's clearly a lot of selling that's going on. But if the bond market continues to sell off, we could see, again, like I said, a lot of bond investors take their money out of bonds, which have been really, really good to investors, and start to put them into more riskier assets. And so that's the big takeaway today. Obviously, time will tell. We don't know what's going to happen, but hopefully this has been helpful. As always, please add your comments to this video and share the video on Twitter and on Facebook if you think this was great. Happy trading, and we'll talk to you later.